Are you worried about the market crash? Wondering how to protect your investments and even profit during a recession? Let's be real, economic downturns are stressful. You see the headlines, the market's tanking, and it feels like everyone's panicking. But guys, that's the exact wrong way to think about it. You see, while most people are running for the hills, savvy investors know that recessions are actually opportunities. I'm talking about once-in-a-decade chances to buy assets for cheap and set yourself up for massive gains down the line. Stay tuned, because in this video, we're diving deep into the strategies that can not just help you survive a recession, but actually thrive. We'll be looking at legendary investors like Warren Buffett and Ray Dalio to understand how they not only protected their wealth, but actually multiplied it during times of crisis. By the end of this video, you'll have a clear strategy to not just survive, but thrive during economic downturns. Remember, this is not financial advice. It's about empowering you with knowledge. Always do your own research and seek professional financial advice before making any investment decisions. Alright, so the market's in a downturn. Everyone's freaking out. What's the first thing you need to do? You need to get defensive. And I'm not talking about hoarding toilet paper. I'm talking about fortifying your portfolio with companies that are recession-resistant. Think about it. No matter what the economy's doing, people still need certain things: food, water, electricity, healthcare. These are your consumer staples, your utilities, your healthcare giants. These companies provide essential goods and services that people rely on, rain or shine. Remember Warren Buffett's investments in Coca-Cola and Johnson & Johnson during the 2008 recession? Classic example. People still drank soda, they still needed Band-Aids, and guess what? Those companies kept chugging along, paying dividends like clockwork. Now, I'm not saying these stocks are going to skyrocket during a recession, but they offer stability. They provide a steady hand when everything else is shaky. Okay, so we've got our defensive positions covered. Now let's talk about how to actually make money during a recession. Because remember, it's not just about surviving, it's about thriving. And the key here is to think like a bargain hunter. See, when the market crashes, it's like a department store having a massive clearance sale. Everything's on discount, even the high-quality stuff. Suddenly, those blue-chip stocks, those industry leaders you always wished you could afford, they're within reach. Now this is where you need to be smart. You're not looking for just any cheap stock. You're looking for companies with strong fundamentals, solid track records, and a competitive edge. These are the companies that will weather the storm and come out stronger on the other side. Think about Warren Buffett's $5 billion investment in Goldman Sachs during the 2008 financial crisis. Everyone thought Goldman was going under, but Buffett saw the value, the long-term potential, and he bought in big. And guess what? He made a killing. All right, let's talk about bonds. Now, bonds might not be the sexiest investment out there. They're not going to make you rich quick, but when it comes to recessions, they're your safety net. Think of them as the reliable friend you can always count on, even when times get tough. You see, bonds are essentially loans you give to governments or corporations. In exchange, they promise to pay you back with interest. Now, government bonds, especially those issued by the United States Treasury, are considered incredibly safe. Why? Because the US government has never defaulted on its debt. It's like the ultimate security blanket for your money. And the best part is, during a recession, when fear grips the market and everyone's running for the exits, bonds often go up in value. It's like a counterintuitive dance, where fear pushes investors towards safety, and bonds are waiting with open arms. Now, I'm not saying you should put all your money into bonds. Diversification is key. But having a portion of your portfolio in bonds, especially during a recession, can provide that much-needed stability and peace of mind. Now, let's talk about real estate. When a recession hits, it can feel like the entire housing market is crumbling around you. Prices plummet, foreclosures rise, and it can be scary. But you know what? This is also where savvy investors can find incredible opportunities. Remember, during the 2008 financial crisis, real estate prices tanked. But guess what? Those who had the courage and the cash to invest at the time were able to scoop up properties at a fraction of their pre-recession value. They were buying those metaphorical dollars for 50 cents. Of course, real estate is illiquid. It's not like stocks that you can sell instantly. But over the long term, if you buy right, hold on, and ride through the storm, real estate can generate significant wealth. One legendary investor who mastered this strategy was Sam Zell. He made a fortune during the early 1990s real estate downturn by purchasing distressed properties. He understood that recessions create buying opportunities that only come around once in a blue moon. Listen, diversification is key to mitigating risk in any market, but it's especially crucial during a recession. And I'm not just talking about diversifying across different asset classes like stocks and bonds, but also geographically. Think about it. Why limit yourself to just the US market? The world is a big place with countless opportunities, especially in emerging markets. These economies are often characterized by rapid growth and a young, dynamic workforce. By investing in foreign markets, you're essentially tapping into a whole new world of potential returns. And if one market takes a hit, your investments in other regions can help cushion the blow. Remember, a recession in one country doesn't necessarily mean a global recession. While the US might be struggling, other parts of the world could be thriving. It's all about spreading your risk and not putting all your eggs in one basket. Now, let's talk about a strategy that's almost as old as money itself. Investing in precious metals. You see, when the market's looking uncertain, people get scared. They want something tangible, something they can hold on to, something that's held its value for centuries. And that's where gold and silver come in. Think about it. Gold's been a store of value for thousands of years. It's durable, it's divisible, and it's universally recognized. During a recession, when the value of paper money can fluctuate wildly, gold tends to hold its ground, sometimes even going up in value. Remember Ray Dalio, the hedge fund billionaire? He made a killing during the 2008 crisis, thanks in part to his investments in gold. Now, I'm not saying you should go all in on gold, but having a small percentage, maybe 5 to 10% of your portfolio in precious metals, can act as a hedge against inflation and market volatility. One of the biggest mistakes investors make, especially during a recession, is trying to time the market perfectly. They wait for the absolute bottom, hoping to buy low and sell high. But here's the thing. Even the most seasoned investors can't predict the market with 100% accuracy. It's like trying to catch a falling knife. You're more likely to get cut. So instead of trying to be a market timing guru, let me introduce you to a strategy that takes the guesswork out of investing. Dollar cost averaging. It's simple, it's effective, and it's perfect for navigating uncertain times. Here's how it works. You invest a fixed amount of money at regular intervals, regardless of the market conditions. Let's say you want to invest $10,000 in the stock market. Instead of investing it all at once, you could invest $1,000 every month for 10 months. This way, you're buying more shares when the market is down and fewer shares when the market is up. Over time, this strategy helps you average out your purchase price, reducing the impact of market volatility on your portfolio. It's like a built-in discount system for your investments. Remember, time in the market is more important than timing the market. Now, you might be thinking, Graham, shouldn't I be investing all my money during a recession to capitalize on the low prices? And while that's tempting, it's crucial to remember the importance of liquidity. You see, having cash on hand during a downturn is like having an ace up your sleeve. It gives you the flexibility to act decisively when opportunities arise. Think of it this way. What if the market dips even further than expected? If you've invested all your money, you'll be stuck on the sidelines, watching those incredible deals pass you by. But if you have cash available, you can swoop in and buy those undervalued assets at a steal. Remember Warren Buffett? He's notorious for keeping a large cash reserve, and it's one of the reasons he's been able to capitalize on market downturns. During the 2008 financial crisis, he had billions in cash ready to deploy. allowing him to make strategic investments in companies like Goldman Sachs and General Electric when they were trading at significant discounts. Now, when the economy takes a downturn and everyone's talking about a recession, it can be tempting to chase after the next big thing, hoping for a quick buck. Penny stocks, options trading, those obscure cryptocurrencies your cousin keeps raving about. They might seem like the golden ticket, but trust me, they're anything but. Remember, recessions are times of economic uncertainty. You want to be focusing on stability and proven track records, not gambling on long shots. Think about it. Would you rather put your money into a well-established company with a history of weathering economic storms, or a startup with a cool idea but no real proof of concept? That's why it's crucial to stick to what you know. Invest in industries you understand, companies with solid fundamentals, and assets with a proven track record. This isn't the time to be a trailblazer. It's the time to be a smart, calculated investor. It might sound counterintuitive, but recessions, while challenging, can actually be a breeding ground for innovation. Think about it. Economic downturns create a need for change, for new solutions, and for businesses to adapt and evolve. This is where the real opportunities lie. Look at companies like Uber and Airbnb. They were both born during the last major recession. While established companies were struggling, these startups saw a gap in the market and capitalized on it, ultimately changing the way we travel and commute forever. This isn't about throwing money at every shiny new startup. It's about identifying companies that are tackling real problems with innovative solutions. Look for businesses that are disrupting industries, leveraging technology in new ways, and adapting to the changing needs of consumers. These are the companies that have the potential to thrive, not just survive, during a recession. And by investing in them, you're not just backing a company, you're backing the future. All right, so you've made some smart moves, picked up some undervalued assets, maybe even diversified into some gold. That's great. But the market's always changing, right? What was a good mix a year ago might not be the golden goose today. That's why it's crucial, especially during a recession, to rebalance that portfolio. Think of it like tuning up a high-performance car. You wouldn't just floor it and never check the engine, would you? You gotta make sure everything's running smoothly, adjust your tire pressure, maybe even swap out some parts for optimal performance. Same goes for your investments. Look at your asset allocation. That's just a fancy way of saying how much you've got in stocks, bonds, real estate, and so on. Maybe the recession hit tech stocks hard, and now your portfolio's heavier on bonds. That might not be bad, but it might not be what you planned for either. Rebalancing means selling some assets that have done well and using those profits to top up areas that have lagged behind. This helps you stick to your original investment strategy and risk tolerance. Remember, recessions can be emotional roller coasters. It's easy to get caught up in the fear and sell everything, or get overconfident and go all in on a risky bet. Rebalancing keeps you grounded, disciplined, and focused on the long game. Now, I know what you're thinking. Graham, this recession thing sounds scary. When's the right time to buy? Look, I get it. Timing the market perfectly is like trying to catch a falling knife. It's risky and you're probably gonna get burned. Instead of trying to be a Wall Street wizard, focus on what you can control: your strategy. Remember, recessions create opportunities. When everyone else is panicking and selling, that's when you can find some serious bargains. Think of it like Black Friday for investors, but instead of TVs, you're buying pieces of great companies. Now, here's the key. Once you buy, hold on to those investments for the long haul. I'm talking years, even decades. The market moves in cycles. What goes down will eventually come back up, and often stronger than before. Look at Amazon during the dot-com bust. Everyone thought they were finished. But Bezos kept his head down, kept building, and the rest is history. This isn't about getting rich quick. It's about building wealth over time. It takes patience, discipline, and a whole lot of ignoring the noise. But trust me, when the market recovers and your portfolio is booming, you'll be glad you stuck to the plan. So there you have it. a crash course in profiting from a recession. Remember, recessions are challenging, but they also present unique opportunities for those who are prepared. Stay informed, stay disciplined, and always seek professional financial advice. Don't let fear paralyze you. See the potential in uncertainty and use these strategies to not just weather the storm, but to come out stronger on the other side. Thanks for watching, and don't forget to like, subscribe, and hit the notification bell for more insightful content.